Good morning and welcome to the Rick Helps Real Estate Show. Let me check the weather here real quick, tell you what we're facing today. It's been a scorcher. I think yesterday was 115. And today, let's see, we're going to be, 116. That will be cheery. And then tomorrow, 116. No, today, 117 on Thursday. But we'll have a low of 90. God, I hate this time of year. It's rough out there, folks. It is just rough out there. Well, good morning. Good morning. Today we have 5,305 homes on the market. That's an increase of 185 from yesterday. And on Thursdays, it just ticks up. We had 12 more homes just added in the last 30 minutes. And then by tomorrow, I expect we'll be up another 200. So we have 4,213 homes come on the market, of which 3,781 went under contract in the past 7 days. That's a difference of 432, and it looks like this. So here's our blue wave. Let's keep this gap going here, right? So we want the blue wave to start coming up. We want the yellow line to stay right there. That is showing us that there is an increase in inventory ever so slightly. And it looks like this. So this is our demand index, and it's an index. Remember, yesterday I was explaining the index a little bit. Antonio, I've got a question on here real quick. What is a good real rental price in this market for an average neighborhood? Good question, because I actually have that subject teed up, so hang in there with me. The Cromford Demand Index is showing that demand is actually almost normal down here at 100. So when you hear everybody say it's a really hot market, things are going crazy, it's only feels like it's going crazy because you got this many people looking for very few homes. So the demand is not off the charts. It's the supply that's killing us. It's so low. See where our supply was before the crash, way up here? That's an index, remember. And then this is barely coming up. With normal being 100 on the index, we're sitting down at like, what is this, 26? So there's not much supply. And this is the Cromford Market Index that looks at both things. So what's happening in the Phoenix market right now, here's a mid-month report from the Cromford Report. So I won't read the whole thing. I'm just going to say that on June 15th, the pending listings for all the areas and types shows an average list square foot of 250.55, up 3.4% from the reading for May 15th. The bottom line is what they're saying is, after all looking at all the data and their projections, thus we are forecasting that price rises return to the kind of thing we were seeing in the first quarter, 3% per month. That's pretty aggressive. And that's where we've been. We got up to 4% per month in April. Now they're forecasting 3% per month. So a $300,000 house, 3 times 3 is 9. There you go, $9,000 a month in value. It was kind of a bit of a Wall Street and Federal Reserve day. The Fed announced yesterday that they're going to shift gears a little bit, kind of be a little, what do I want to say? They're talking about, they used to say they were talking about raising rates, or they were not even talking about raising rates. Well, now they're saying, well, probably 2023, because they're seeing the inflation data looks like it's starting to stick. And so it says here that though policymakers have yet to agree on a plan, most expect by the end of 2023 they will have raised the Fed's benchmark short interest rate at least twice from the current near zero level. So what is this telling you? This is telling you that they intend on letting everybody know well in advance that they're going to be raising rates in 2023. They don't want to stun people like they did in 2018 and just clamp down and raise the rates because they thought the market was getting too hot, because the markets reacted negatively. So they're trying to give the markets plenty of time to get ready for this. And it seems to be working. The stock market went down a little bit yesterday. The mortgage interest rates crept up. But keep in mind that it was just a very, very tiny tick upwards, but up is up. And we're still sitting at about 3.18 as far as those rates go. So it's not a shocker. Our rate's going to go up next year. Sure looks like it. Looks like that's exactly what they're talking about. But we don't know how high. I mean, if we're sitting here next year and we're at, what, 3.5, I don't think that's going to shock anybody. But that's the signal that they're sending, is that they're getting ready to do this. So that's going to be interesting to watch. Now, there's a lot of other market forces that can make rates spike up as well. So we continue to watch all of these numbers right here on a daily basis. Wall Street workers want Florida transfers as job waiting lists grow. That's interesting. Basically, what they're saying is these big Wall Street firms are facing difficulties convincing employees to return back to office in a post-COVID-19 environment. They're facing yet another headache from within their ranks: growing demands to relocate out of New York to Florida. They want out of there. Job headhunters say banks such as JP Morgan and Goldman Sachs have what is being described as a waiting list of executives looking to move to the Sunshine State, primarily because of its lower cost of living, but also because of the quality of life issues, including a lower crime rate. Manhattan, where both firms are located, is dealing with a spike in crime and homelessness. Under Mayor Bill de Blasio's crime statistics have risen in most categories, with the New York Police Department reporting a 39.6% rise in grand larceny thefts last week for 4 weeks ending June 6th. So they want out. And so they're telling these headhunters, let me know if anything pops up in Florida, I'm going to take it. And they really don't want everybody to relocate to Florida. So the banks are giving people the opportunity on an internal basis. They're saying, well, look, if anything opens up, in Florida, we're going to give it to our internal people first, the people in New York that want to move. So it's highly unlikely that any external candidates already living in Florida or any external candidates in New York that don't work for one of those firms is not going to get that job posting. It's going to be the job postings that they're just going to transfer somebody from New York down to New Jersey. And so we've got a couple chats here. Let me answer Judy's here real quick. I remember, not a question, just a comment. I remember the days when a good interest rate was 8%. I've been alive long enough to know of 13%. So get what you want now and plan on it being a long-term residence. I couldn't agree more. I mean, my first one was 11 3/4, and the house was $112,000 up in Seattle. And boy, when I got that thing refinanced to 9.5, I was just thrilled. But it was the payment. It was, you were just looking at the payment saying, can we afford this payment? And every time you always had an opportunity to refinance down the road, because going from the high interest rates that started in the late 70s and early 80s down to like 85, that's when you could kind of start getting the 8s and the 9s. It was a long, long time before anybody saw a 7. And I remember my dad telling me about his first VA loan that was 4%. And I couldn't even fathom. I was like, really, Dad, you had a 4% mortgage? So rental question. Antonio says, Rick, what's a good rental price in this market for an average neighborhood? Got some sad news here if you're looking to rent. Now, if you're trying to rent your house out, then you'll like this. But this is from Realtor.com this morning. Rental prices climbed to the highest level in 2 years. This is the U.S. median rental prices. Monthly rents rose 5.5% year over year and averaged $1,500 in May. 1-bedroom and 2-bedroom rentals climbed to the highest levels since May at $1,718 and $1,422, respectively. Rents for studio apartments rose for the first time in the last 10 months. A median price of $1,254. Rents in 38 of the 50 largest metros reached new price peaks. So let's see if they have Phoenix listed here. Here's Phoenix, Mesa, Scottsdale way down here. They're saying the average rent is $1,543, up 16.8%. That's a little brutal. So the average rent here, there's a big difference between apartments and single-family homes, but and it also depends on the area. In North Central Phoenix, where I live, it's brutal. You try to find a 3-bedroom, 2-bath single-family home, you're paying in the high mid twos, if not more. Um, Apartments, 1 bedroom apartments at a minimum, $1,400-$1,500. That's just for a 1 bedroom. Now, if you get out in the suburbs, it gets lower, but it's still not nice. And and it doesn't look like it's going to slow down anytime soon. We are seeing a bit of a slowdown in the market, but not much in rentals, that's for sure. Um, Another article here says the Fed doesn't expect rate hikes until 2023, but they could affect today's housing market. This is from Realtor.com. It says, in a vote of confidence in the nation's strengthening economy, the majority of Federal Reserve members now anticipate raising the interest rate twice in 2023. While this wonky monetary projection may sound like a long way off, it could have a real impact on today's overheated housing market. So they're saying that it could have an impact, but I don't know what the impact's going to be. If they're thinking about raising rates and they're talking about it 2 years now, the impact may be that people are going to flood out there and try to grab something now while rates are low, but that just increases the bidding wars, right? So, and that's the last thing we need. We don't need to be seeing that. I am hoping that our inventory continues to climb and that our sales remains at a steady level. But it doesn't take much in consumer sentiment to make that move. If people feel more confident and they like the rates and they feel like they're in a good position to buy, that's going to flood more buyers out in the market. If the government does something silly of offering down payment assistance grants, that's just going to make it even worse. But you remember what they said, we're from the government, we're here to help. G Dirt, Rick, I'm having a hard time deciding between a condo, $250,000, or a house, $400K or so. The goal is not to lose my rear end in the near future. Any insight would be appreciated. Near future is a tough one. I don't know where real estate prices are going to be in 5 years. I know where they're going to be in 1 year. They're going to be higher. Are we going to have any kind of economic calamity that's going to slap us around a little bit in 2023, 2024? I don't know. My crystal ball is broken. I do know that what concerns me about condos is what you're trying to do is you're trying to get a place to live, a residence, and get a fixed payment. Condos don't always have a fixed payment. If it's managed well, your HOA can kind of stay steady. But sometimes if they're not managed well, it goes up. Like if the market goes down and people start selling their condos, or some people even walk away from them, you still have the shared costs with the community. They raise the doggone HOA fee. You don't have that happening in a single family home. You may have a small HOA fee for community grounds and stuff, but they don't tend to go way up. I've seen HOA fees as high as $400 a month in some condos. So that all depends. Now, the beauty of a condo is you don't have any yard work. Your utility bills are lower. But they tend, when the market turns, condos tend to go down quicker and faster in value than single family homes. Right now, there is a rush to get space. People tired of renting, tired of community living, and want to get their own place. They want their dog to roam free in the yard. So that's what's driving the housing market for single family housing. So, but you might find something for $250K that's really nice. You can leave town for a couple of weeks, not have to worry about anything because you're in a condo. You don't have to mow the grass. You don't have a pool you have to take care of. So it really depends on which one fits better in your financial plans. Trying to buy something to predict where it's going to be in the future is just kind of folly right now because none of us know. None of the experts know. Everybody's trying to guess. All the crashers out there are telling you it's going to be a bad idea. Don't get in now. But they provide very little anecdotal evidence saying why. I looked at the foreclosure numbers in Arizona, and they're not even 1% in pre-foreclosure. So like 0.3, they're non-existent. If the forbearance homes all of a sudden flood the market, then hey, guess what? All that's going to do is our blue line is going to be bigger than our yellow line I showed you on the graph, and the market could normalize. It's not going to crash it. It's not a big enough number to crash anything. If all of the rentals, when the rental moratorium ends, and all these renters get booted out and the owners decide they're going to sell them all, it's going to have the same effect. 23% of our homes in the Phoenix area are owned by investors as rentals. There's no way that all 23% are going to dump these homes because the cash flow is too good. They bought the majority of them 2011, 2012. So their payment's this much, but they're making this much. Why would they sell it? Just because they went through a period where renters weren't able to make their rental payments. So I think I don't see any of those things coming along. Now, banking is nervous. They're having some issues in banking. Right now, they have too much cash. And if you think about it, banks don't want to have a lot of cash. They want a lot of equities. Like JP Morgan came out yesterday and said they're going to hang on to more cash because when interest rates go up and treasuries are paying more interest rate, they want to take all that 600 billion in cash they got and start buying more treasuries and making more money. But they're not lending as much. There is some lending tightening going on out there. And I want to talk to Pat about that tomorrow and see what he's hearing or seeing. And so my bottom line is I don't see anything in the real estate market per se that signals trouble, except prices are just going up, up, and up. And people think, well, they're going up way too fast. They're going to pop. The article I read yesterday said, that we're in a bubble. But then at the end of the article, they said, it's unlikely that we're going to see anything crash. We may just level out. Well, then don't give me a headline that says it's a bubble and then make me read all the way to the bottom going, actually, it's probably we're going to be fine. So there's a lot of headline grabbing out there. If we're going to have a bubble, then tell me how far real estate values are going to go down. I'm all ears. I'd like to hear it. I'm not trying to project where we're at. I'm just trying to look at these numbers every day and say, okay, if we're going to have a bubble, and we're going to have a crash, then this is going to change. This blue line's going to go crazy, right? If we're going to have a bubble and we're going to crash, then sales have to drop. And there has to be a combination of the two. We have to see huge moves in inventory. So the Crawford report right now is looking at how many homes we have on the market and our sales, and they're projecting for the next few months, 3% a month, based on how many homes are out there, the velocity of which they're going under contract, and the scarcity of inventory. And they're saying we're going to be back up to 3% per month. They don't even project next year. So I'm not about it. So I hope that helps. I mean, I know I kind of drove around the building a little bit there, Dirt, and wish you the best luck in your search. So just do a lot of work with the math and figure out what you want to be. Tomorrow I'm going to be on with Pat at 3:00. We're going to do some deep dive into lending, talk about what happened to rates this week, and I have a few other questions for him as well. Take on the day. Have a terrific Thursday. Thanks, everybody.